Good afternoon. Thank you for having me, and congratulations in particular, Kyle and Jeff, for look what you've built. It's unbelievable. Congratulations. So very briefly on vision, what we do is we are focused on publicly traded real estate securities, both equities and debt. We operate long and short. So our strategy is not designed to be bulls for real estate. We seek to outperform irrespective of real estate fundamentals or valuations. We seek where relevant and appropriate to be active, value-add, strategic investors. We don't seek to be hostile. It takes you 30 years to build a relationship, and you can lose it in one day. We have benefited, including the two takeovers Eric mentioned, from 19 takeovers in the prior 13 years. Our strategy is a combination of a top-down and a bottom-up approach to identify the underlying net asset value of the real estate. What is that real estate worth in the property market, and then compare it to what it is trading at in the stock market. Essentially, we seek to buy real estate cheaper in the stock market than one can in the property market. And the advantage of doing that relative to what I used to do, or those that invest directly in the property market, is by definition, you can't buy real estate cheaper in the property market than the property market. Why do we need to be one of the 17th entities to compete against a pension fund or a REIT or an entrepreneur with too much money in his or her jeans to buy property in an auction hosted by CBRE or Colliers, when we can buy real estate at 60, 70, 80 cents on the dollar in the stock market? Get professional management, get corporate governance, get liquidity, get geographic diversification, get property type diversification. Nobody calls us in the middle of the night to fix the heater, and the opposite is true. If the fundamentals are negative or deteriorating or valuations are excessive, you can't do anything about that in the property market. We can and do things about that. We can short real estate. Returns have been pretty good, just under 13% compound annual returns, but the most important thing to us, returns are good, but we don't seek to be the best performing fund in North America. We'd like to be the very best risk-adjusted performing fund, and that's where we really stand out. Some of our risk metrics, for those who are familiar with them, we've never had a negative year, and that includes 4 of the last 8 years where REITs 2013, 15, 18, and 20 were negative, or the broad market was negative. What we're going to talk to you today is an investment in the rental apartment space. This is a very interesting space. COVID-19 certainly has not changed the landscape for rental apartments. It's expensive to buy a house, that's for sure. Institutional investors are grabbing at this space. You've seen, since the pandemic started, an increase in valuation, and it's the most defensive real estate asset class. Everybody needs to live somewhere, and compared to condos, where you don't have any certainty of tenure, you get professional management, and so you get growth, yet a defensive investment. Immigration. Why Canada? 1.2 million immigrants coming to this country over the next 3 years. They live in apartments. You have limited new supply, and you have significant population growth, and that ratio is around 2.5 population growth to that new supply. Affordable apartments, we believe, is the place to be. Immigration. COVID is relevant because Canada looks pretty good on a global stage, and this will allow that immigration to bolster Canadian apartments. Canadian economic recovery is enviable. You look at the G7 and the change from the fourth quarter of 2019 into the last quarter, Canada leads the G7. You look at 23 major economies. Our population growth is highest, and you will note the light blue bar, where a lot of that is the aforementioned immigration. Employment growth, solid. Canada's recovered 100% of the jobs we lost in the pandemic, whereas the US is still 5 million jobs short. That's the demand side for real estate. Well, there's strong demand from population growth. Supply has been stagnant. It really hasn't moved from the long-term average. It's now a 15-year average, about 200,000 new units per year across the country, and that's a good formula for structurally higher demand. You look today, as a result, the ratio between population growth to housing supply on a long-term basis was 1.7 times. Today, 2.7 times. That's a good number, bolstering this suggestion. And while wages have tracked rents, they've been pretty much in line. Home prices have more than doubled relative to both of those factors. And so it's tough to buy a house, and affordable apartments are a great alternative for Canadians. Our recommendation today is Boardwalk REIT. For us at Vision, it's a little bit back to the future. A co-founder of Vision, myself, Frank Mayer, were instrumental in the early stage of Boardwalk subsequent to their IPO between 1995 and 1998, supporting their growth. Today, Boardwalk has 33,500 apartment units across the country, an IFRS asset value of $6 billion, and continues to benefit from strong alignment of ownership from the founding family, which has over 25% insider ownership. The Boardwalk's the only Canadian apartment REIT which has increased its net operating income from pre-COVID levels, and yet its unit price is below pre-COVID levels. Heavily concentrated in Western Canada, about 73% in Western Canada, with about 62% of that in Alberta. And while the Alberta economy is certainly diversified, which we're going to touch on in a moment, it is definitely benefiting from this boost to the energy sector, which looks like higher for longer to the lack of investment in this sector. Affordability, great place to have affordable apartments. The average rent per square foot per month in Boardwalk, pick Calgary, $1.90 per square foot. Edmonton, $1.47. You compare that to Vancouver and Toronto, over $3 per square foot per month. So they screen affordable and are attractive to Canadian residents, both migration and immigration. And whether it's the last 10 years or the last 5 years or the last 1 year, as a result, that's where the population is going. This is not well appreciated. The lower cost of living, lower taxes, higher quality of life is driving population growth to Alberta. Employment, you take out some of the smaller markets in Atlantic Canada, Alberta has led the country and is forecast to lead the country in terms of job growth. Supply has been muted in Edmonton with about less than 0.5% annual increase in supply. And in Calgary, despite the population increasing 76% over the last 20 years, the apartment stock has actually declined. The inventory has gone down by 13%. I don't think this is well appreciated. There's been a 40% decline of the importance of oil and gas to the Calgary economy over the last 20 years, and a doubling of the importance of professional scientific technology jobs to that economy. And the apartment market is somewhat related, of course, significantly related to the overall level of economic activity, and as an affordable place to live, as an affordable place to rent, with rents in industrial 45% cheaper than Vancouver, you're seeing distribution centers for the West moving to Calgary. There was an article in the Globe and Mail last week that talked about companies that are unloading their goods from Asia in Vancouver, immediately transporting them to Calgary, and then distributing them from Calgary to Vancouver because the overall logistics cost is 30% lower in doing so. So no surprise, Cisco, Canadian Tire, FedEx, Walmart, Lowe's, all developing new logistic hubs in Calgary. Again, a tech hub, quietly becoming a tech place because of the lower corporate taxes, because of the affordable living, because it's a great place to live. They're attracting a lot of technology jobs. There's been a 38% increase since 2018 in the number of tech companies between $1 million and $15 million in revenue. Edmonton is ranked, the University of Alberta, third in the world as a center of artificial intelligence. Edmonton, after a challenging 2020, it's looking to rebound quickly because of this rebound in oil and gas. And unemployment peaked at over 15% last year and is expected to fall to 6.9% by 2024. Similar to Calgary, industrial started a little bit lagging, but starting to pick up there as well, has a lot of advantages in terms of transportation access. And it's notable Amazon, for example, is building a 3 million square foot, 5-floor logistics facility in suburban Edmonton. Boardwalk, as I mentioned, 33,500 homes, large apartment suites, 867 square feet average size, $1,144 average monthly rent, $1.32 per square foot per month. You want to talk about affordability? Well below 20% rent to average renter household income in Calgary and Edmonton. And these are all their markets in the chart. And you compare that to Toronto, where that metric is 33%. Occupancy is increasing, and this is important. This is a gross rent business, so a little bit of occupancy goes a long way to gross margins. And one of the overhangs on Boardwalk's share price has been a lot of concessions in these markets to keep them full. Well, you get to 97%, and their last quarter they averaged 95.8, so we think that's the number. We think concessions start to go off. We think they're pretty much gone this year in Calgary, and Edmonton will not be far behind. Not just Alberta. 27% of this portfolio is outside Alberta, and this is some pretty attractive and undervalued piece of this puzzle. This is you look at private market transactions, 3% cap rates. The implied cap rate that Boardwalk stock is trading at today, 5.4%. This is an area we think will change at Boardwalk. We think they're significantly undervaluing their Quebec portfolio. They are valuing their portfolio at between $145,000 and $168,000 per door, or a 5% to 5.2% cap rate. Whether it's the public markets or private markets, this is way off. You're seeing in the private markets transactions between $200,000 and $400,000 per suite. And their peers at Minto and InterRent and CapREIT are valuing their Quebec portfolios at between 3% and 4% cap rates. We think there's $3 per unit upside in Boardwalk's IFRS reported accounting value just from Quebec. So this is set up for material cash flow growth. You take these building blocks, the last quarter annualized, we're looking at $3 per unit cash flow, FFO. Add in 11 cents for stabilizing that portfolio to 97%. Remove concessions, you had 77 cents. You mark to market just on the current rents, never mind future growth. Current rents, you mark to market their portfolio in Quebec and Ontario, you get 17 and 21 cents respectively. That takes cash flow from $3 a unit to $4.26, 42% cash flow growth that we see in the near term for Boardwalk. Typically, when fundamentals are strong and you see growth, stocks trade at premium. Well, not here. This stock is cheap. It's ridiculously cheap. You look at the peers, they're trading at a 24.3 times cash flow multiple using 1-year forward numbers. Boardwalk multiple is 14.4 times, 10 multiple turns lower on cash flow. Our key metric, net asset value, the value of the real estate, the peers are trading at a 5.1% discount to the underlying value of the real estate, or a 4.1% cap rate. Boardwalk trading at a 32% discount, just on a 1-year forward basis, or a 5.4% cap rate. That's 45% upside relative to the peers. Again, typically higher growth, better fundamentals, higher multiple. A 10 times discount in terms of comparing growth, that multiple to the growth. Public markets ignoring this. Historically, Boardwalk traded at a multiple turn that was 2.2 times higher than their peers. As noted, today it's 10 multiple turns lower. You could have a whole hidden company within Boardwalk based on the value. Private market gets it. They get it. Look at the transactions. Edmonton, Calgary, London, Kitchener, 3.5 cap, 4 cap, 4 3 caps. Never mind 4.34. You put a 4.5 cap rate on Boardwalk, which today is trading at 5.4% implied cap rate, you get a $74 stock price for Boardwalk. Balance sheet's improving. Just stabilization, nothing else. Just stabilizing this portfolio, you're going to see net debt to EBITDA go from 13 times to 9.9 times. The current comp set in the peers is 10.3. Huge short interest in the stock. Very bullish for the stock price. In addition to the fundamentals, you're looking, particularly Americans, you see the short interest. They don't get it. They're not following what's going on in Alberta. We all saw what happened to AMC, GameStop, and Macerich. They surged. I don't know if that's going to happen to Boardwalk, but I can tell you one thing. There's only one investor that I know in the planet that's going to buy this stock, and that's somebody who's short. Very bullish. So we see numerous catalysts to surface value here. Strengthening Alberta economy, increasing occupancy, driving the reduction and elimination of concessions, improving NOI margins, improving leverage ratios, that recognition of the private property market pricing, more realistic IFRS values, we challenge management to do that, reversal of that large short interest. I didn't mention, but one of the earlier slides, very low payout ratio, about half the payout ratio of their peers, so this could portend a distribution hike. Management's aligned. They don't need to go and buy apartments when they can go buy apartments through buying their stock and have the financial capacity to do so. And if this persists for a longer time frame, they are aligned to surface this value through M&A activities. Bringing this together. We talked about that upside to $75. But if you want to look at the full NAV potential here, take that $51 current share price, add in the $2.14 from going from 95.8% to 97% occupancy, reduce concessions just by 40%. You get $8.82 upside. You fully eliminate them, you get another $6.81. You mark to market the Ontario and Quebec rents, you pick up another $7.67, and you reduce that cap rate still well above market, but the 4.5%, you get another $15. We see a fully stabilized net asset value potential of Boardwalk of $92. If you're interested in more information, I think my colleague Darren is there. He can talk to you about Boardwalk or anything we're doing at Vision. Thanks very much for having. Congratulations to everyone again.